This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do.
Rally pauses. The recent stock surge seems to have taken a breather. But will the bulls remain in control and send the Dow to 20,000?
Golden age, why a well-known investor says bank stocks are entering a gilded era.
Billion-dollar fraud. Hedge fund executives are accused of bilking investors in what's being called a Bernie Madoff-like Ponzi scheme. Those stories and more tonight on Nightly Business Report for this Monday, December the 19th. Good evening, everybody. Welcome. I'm Bill Griffith, and tonight for Tyler Matheson.
Great to have you here.
Thank you.
I'm Sue Herrera. Well, Dow 20,000 remains within reach, but after a few attempts, the blue chip index has fallen short of that landmark level. Today, gains were trimmed when reports surfaced that Russia's ambassador to Turkey was shot and killed in Ankara. Investors were also rattled this afternoon when several people were killed by a truck which drove into a Christmas market in Berlin, Germany. So with one eye on overseas events, the Dow Jones Industrial Average rose 39 points to 19,883. The Nasdaq was up 20, the S&P 500 gained 4. Today's modest moves mirror those of the past few days. And as Bob Pisani explains, some investors may be questioning the strength of the recent rally.
Stocks were again little change today, with the Dow up only fractionally today and in the last 5 days. The assassination of the Russian ambassador to Turkey may have taken some of the winds out of the modest morning rally. Still, it's been a remarkable 5 weeks since the election, with the markets up about 6%, largely on a belief that a proposed combination of tax cuts, fewer regulations, and a massive stimulus program will somehow translate into a surge in corporate profits in 2017. But that hope can only push stocks so far. There's a battle going on. Instead of bulls versus bears, let's call it the pragmatists versus the optimists. The pragmatists are saying the stock market's going too fast. We don't know how tax reduction and stimulus programs are going to impact earnings, because we don't know what the numbers are going to be or the programs will be. The optimists are saying, use your imagination. We don't have to have all the numbers, but we know all this is going to be good for stocks. Now, this may be a very flimsy foundation for a stock rally, but that's essentially where we are now. And that flimsiness may be why the market is starting to look a little trendless. Former market leaders like banks and industrials and materials that went up big in November, they've sort of stopped rallying. And while November laggards like consumer staples and utilities are trying to make up for the difference, investors in the past week haven't been buying with quite the same enthusiasm as the prior month. Now, a pause after such a big rally is certainly in order, and you could perhaps forgive investors for being a bit uncertain. Should they buy more or sit tight or take profits and hope the markets will drop so they can buy lower? There's no agreement on the direction right now. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
You know, since the election, the financial sector has been the best performing sector overall. Banks are benefiting, of course, from higher interest rates, and they're rallying on the assumption that a Republican administration will reduce those regulations that were put in place after the financial crisis. Financials are up 17% since November 8th, and they've advanced more than 20% just this year. And in an interview today on CNBC, a well-known investor who correctly bet against subprime mortgage securities during the financial crisis, well, today he said he's now very bullish on the banks.
What I think is going to happen is I think the financial system is going to be at least partially deregulated. I think over the next couple of years there'll be more leverage, and this will be a golden age of investing in financial stocks.
So you would be very long right now, financial stocks?
As long as I could be.
As long as, and is that what you are?
And that is what I am.
So is it time to invest in the banking sector for the long term? And if so, what should you know before you do? Joining us tonight to talk about that, Eric Wasserstrom is Managing Director at Guggenheim Securities. Good to see you. Thanks for joining us tonight.
Thanks for having me.
Are you as bullish on the banks as Steve Eisman is right now?
You know, I'm afraid that I'm not. You know, I think if I were to categorize myself relative to what Bob just discussed in your previous segment, I'm more in the pragmatist camp. And while we've seen a couple of positive things happen, particularly with respect to the shape of the yield curve, many of the other things that I would argue is being discounted in bank stocks are still, I think, very early, and I'm in a little bit more of a wait-and-see mode to see if they, in fact, benefit future earnings.
One of the things that has been pointed out by a number of analysts as a bullish scenario is regulatory reform. But you seem to think that perhaps not as much reform is going to happen as a lot of people think.
Yeah, Sue, that's correct. So the big debate is really around the repeal of Dodd-Frank. And I would say quite flatly that the likelihood of repeal or even significant reform to Dodd-Frank is zero. The one thing you could see is some new legislation targeted at regulatory relief for smaller community and regional banks. But broadly speaking, I don't see a high likelihood of deregulation as long as that requires 60 votes in the U.S. Senate, which it will.
Having said all this, though, Eric, you still have buy recommendations on some of the big banks. You've got on Citi, on Morgan Stanley, and some of the regionals. So put this in perspective for us. Are you buying them now, or what are you doing with them?
Well, generally speaking, I would argue that the space broadly is now certainly at the top end of our range of fair value. Within that, we continue to favor the names where there's actually an idiosyncratic reason why we think their earnings will go higher, rather than a dependence on just improvement in the macro environment, which we find at this point a very uncompelling case given the run in the stocks.
What about earnings? You mentioned that, and you know, one of the issues for the market has been the expectations that earnings are going to continue to deliver on perhaps the top end of estimates. Would you fall into that camp, or are you equally as cautious on the earnings front?
Well, I think you have to sort of parse a bit what the drivers of earnings may be. So probably the most significant one, of course, is the net interest margin, which responds to the shape of the yield curve. The yield curve has steepened, so that's positive for banks. And the short end may come up through rate hikes, also positive. Net, we think those things contribute about 4 to 5% of earnings. Obviously, that alone wouldn't explain a roughly 25% move in the stocks. So we think what's also being discounted is things like more robust capital markets and a lower corporate tax rate. And again, we would say it's just very early to conclude that those things are happening.
Eric Wasserstrom from Guggenheim Securities. Good to see you again. Thank you for joining us again.
Thank you for having me.
You bet.
Well, it's almost the end of the year, and the past few Januaries have been anything but kind to investors. The markets seem to suffer from a New Year's hangover. But will 2017 be different? Mike Santoli takes a look.
As investors prepare for 2017, the ghost of January's past might soon disturb their sleep. The stock market has finished strong in December the past 3 years, but in each case, stocks stumbled into the new year, losing an average of nearly 4% in the month of January since 2014. This year's January drop led ultimately to a harsh 15% downturn into February. Wall Street is now trying to figure out if the market is again set up for a similar hangover following the current rally. The bad news? The Dow does seem ripe for at least a pullback after its 8% surge since Election Day and the rush of investor optimism that's accompanied it. But a variety of economic and financial factors are in better shape now than they were heading into the market skid a year ago. For example, the current rally is quite broad, with the majority of stocks taking part in the gains, while last year's market was driven only by a small handful of big stocks. Analysts are also impressed that the sectors geared to economic acceleration are in the lead. These include semiconductors, banks, and transportation stocks. The bond market has better behaved, too. The recent lift in 10-year Treasury yields to 2.5% builds in a better growth and inflation outlook. And the corporate bond market is quite strong, in contrast to last year when risky corporate bonds were tumbling in value as oil collapsed and global industries slowed. On the corporate front, earnings are projected to grow again over the next few quarters, unlike a year ago when companies were in the middle of a long stretch of declining profits. All these factors suggest that any dip in stocks over the coming weeks is less likely to be as dangerous as last winter's sell-off. Now, that doesn't mean all risks have been banished, of course. Stocks are about as expensive relative to corporate earnings as they've been this entire market cycle dating to 2009. The U.S. dollar, for its part, is at a 14-year high against world currencies. This will restrain profit growth from U.S. multinationals and could destabilize emerging market economies and exacerbate trade tensions with China. And of course, it's far from clear exactly what tax and spending policies the Trump administration will propose or get through Congress. The first year of a new presidency historically has been bumpy for markets. All things considered, though, Wall Street seems better prepared to avoid a nasty hangover from its year-end celebration come January. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
Elsewhere, Deutsche Bank could settle with the Department of Justice this week. And at least according to Reuters, the amount they settled for could be less than the $14 billion originally reported. This settlement, of course, relates to the sale of toxic mortgage debt that contributed to the 2008 financial crisis. Back in September, there were reports that surfaced that Deutsche Bank could face that $14 billion penalty, and it prompted the bank to deny speculation that it needed any bailout from the German government.
The head of the International Monetary Fund has been found guilty on criminal charges linked to the misuse of public funds. The case is linked to Christine Lagarde's time as France's finance minister. The judges did not impose a fine or sentence. Experts say that may allow her to keep her position at the IMF, but the organization's board will have the final say.
A hedge fund founder and other executives were charged today with defrauding investors, making it one of the largest alleged scams since Bernie Madoff's Ponzi scheme. Andrea Day has our story tonight.
Today, we're announcing the arrest of 7 individuals associated with a New York-based hedge fund called Platinum Partners.
An alleged billion-dollar fraud with many high-level executives taken into custody early this morning.
Mark Nordlich, Platinum's founder and chief investment officer, and co-defendant David Levy, Platinum's co-chief investment officer, are both charged together with 3 other co-defendants.
Investigators say the billion-dollar scheme worked like a classic Ponzi, and when the money started to dry up, some executives at Platinum Partners panicked and booked flights out of the country.
These defendants defrauded Platinum's investors by falsely portraying that their flagship hedge fund, PPVA, was thriving when it in fact was not.
Investors were left desperate for their money. According to the indictment, one writing in an email to executives at the firm, "I don't know who is in charge now, but I know it is unacceptable."
Platinum created the PPVA fund in 2003, and every year since then, through 2015, it reported on average positive annual returns of 16.8%, and not a single down year.
In its prime, the New York-based fund had nearly $2 billion in assets under management. But prosecutors say in the past years, executives lied to investors and plotted ways to cover it up.
Between 2012 and 2016, Platinum collected more than $100 million in fees from the fund based on their inflated valuations. Platinum Partners held no more value than a tarnished piece of cheap metal.
And the SEC in court documents today saying executives at the firm paid back their favorite investors first, allegedly describing what was happening internally at the firm as Hail Mary time. In Brooklyn, I'm Andrea Day for Nightly Business Report.
Still ahead, perfect timing, the encouraging message the chair of the Federal Reserve has for recent college graduates.
Major cities across northern China were under a blanket of smog on Monday. In fact, it was so bad that businesses were shut down and air and ground traffic was disrupted. More than 20 cities issued red alerts, which are expected to remain in effect through Wednesday. And this all comes as political and economic tensions continue to linger between the world's 2 largest economies following the seizure of that U.S. naval drone last week. Eunice Yoon has more for us tonight from Beijing.
China's foreign ministry attempted to ease tensions over the drone, saying that the Chinese and U.S. militaries were in direct talks to negotiate the handover of the drone. The ministry also cautiously defended Beijing's actions, saying China's Navy had a responsible and professional attitude to identify and ascertain this object. If you discover or pick something up from the street, you have to examine it. That was a very different tone from what was coming out of the state media, which both defended Beijing's Beijing's actions strongly and mocked Donald Trump. The People's Daily called the U.S. survey ship a serial offender spying against China. The official press more broadly attacked the president-elect, calling him emotional for tweeting that Beijing should keep the drone. The nationalist Global Times said Trump's tweets just add fuel to the fire and said Trump is not behaving as a president and has no sense of how to lead a superpower. Trump has indicated that he wants to become much more aggressive on the South China Sea. His choice for Secretary of State Rex Tillerson also suggests a tougher line. Under Tillerson, Exxon teamed up with Vietnam for oil exploration in the South China Sea, drawing protests from Beijing. Now, analysts I speak to say that Beijing is officially showing some restraint. However, they believe that if Trump were to carry out his aggressive stance and turn that into official policy, that Beijing would also react with stronger action. Some of the ideas are that Beijing could recall its ambassador or perhaps even cut diplomatic ties. Now, the state media appears to be attempting to steer Trump away from confrontation. The China Daily said that Trump should take President Obama's advice and think through what the consequences are before upending long-standing policy. For Nightly Business Report, I'm Eunice Yoon in Beijing.
President-elect Donald Trump has picked a conservative congressman to be his budget chief and run one of the most powerful and influential economic agencies. Mick Mulvaney is a fierce deficit hawk with a record of pushing deep spending cuts to balance the budget. Eamon Javers is covering the story for us tonight from Washington. Good to see you, Eamon.
Yeah, hi, Sue.
So if Mick Mulvaney is a fiscal conservative, how is that going to gel, or will it gel, with Mr. Trump's calls for massive infrastructure spending?
Yeah, that's going to be the fascinating point of tension here. Mick Mulvaney is one of the members of the Freedom Caucus up on Capitol Hill. He's a Republican from South Carolina, very conservative. He's even billed himself as a member of the Shutdown Caucus. He doesn't want to see any spending that's not paid for by other spending cuts traditionally. The question is, how is he going to view Donald Trump's infrastructure spending plans? Will they be able to come up with a way to cut as much as they spend, and where will they find those other cuts? That's going to be on Mick Mulvaney's plate when he gets into the OMB in January. It's going to be a very, very tough task.
Then, on the other hand, though, Eamon, you have the president-elect's criticism of some of the aerospace contracts we have, most importantly, the Air Force One deal that he claimed was $4 billion. How does that jive with Mr. Mulvaney's strategies?
Well, and that's an interesting one that you mentioned, Bill, because Mulvaney has been one of the few Republicans who's willing to call for cuts in defense spending as well as in other domestic discretionary spending. So traditionally, you see a lot of Republicans who call for spending cuts, but not on the Pentagon. Mulvaney has said that he would like to see defense cuts as well. That seems to align pretty well with what Donald Trump has been saying about some of these defense contracts. They're too expensive, and the contractors are sort of having one on with the U.S. taxpayers here. So that could be an area of convergence. But the whole question of transportation and infrastructure is a really prickly one, and we're going to have to wait and see how they resolve it.
Eamon, thank you, as always. Eamon Javers in Washington.
Meantime, Apple appeals that European Union's nearly $14 billion tax order, and that's where we begin tonight's Market Focus. Back in August, you'll recall the EU slapped the tech giant with that multi-billion-dollar tax bill, alleging that the company accepted illegal state aid from Ireland in return for creating jobs in that country. Today, though, Apple said that it has now formally appealed the EU's decision, adding that the agency retroactively changed the rules and also disregarded decades of Irish tax law. Shares of Apple rose fractionally today to $116.64. Meanwhile, homebuilder Lennar said today that an increase in orders and higher average selling prices helped that company post better than expected earnings. The company also said that it expects to perform well under a Trump administration, even if the Fed does continue to hike interest rates. Shares of Lennar down 2 cents to $43.40. And shares of Clovis Oncology got a lift today following the FDA's early approval of the drug maker's treatment for ovarian cancer. The medication is intended to treat women who have an advanced form of the disease and who have specific gene mutations. Shares surged more than 8.5% today to $40.48.
Land's End has named a new CEO, Jerome Griffith, not Bill Griffith, who is the former chief executive of the luggage maker Tumi Holdings, will take the helm of the clothing retailer in March, succeeding the company's 2 interim CEOs. Land's End shares rose nearly 4% to $1,775. And Boeing warned that it may cut additional positions next year in an effort to cut costs. The aircraft maker said some of its cuts will be a part of a voluntary layoff program in one of its units, but the company did not disclose how many jobs will be lost. Shares rose 1% to 156.18.
The chair of the Federal Reserve had some encouraging words today for new college graduates. The class of 2016 is entering the strongest job market in nearly a decade. Steve Leisman has more.
Fed Chair Janet Yellen had a mid-year message for college students. Stay in school and get that degree. In a commencement speech at the University of Baltimore, Yellen told graduates that the pay gap between those with college degrees and those with only high school diplomas has widened from just 20% in 1980 to a whopping 70% now. But graduates only get those benefits if they, well, actually get the diploma.
Research shows that a large share of the benefits I've described from higher education comes only to those who graduate. Even those completing 3 or more years of college benefit much less when they don't get a degree.
For example, Yellen said that college graduates usually find jobs that allow them to pay off their student loans, and there's more.
Beyond these advantages, research also shows that a college or graduate degree typically leads to a happier, healthier, and longer life.
Those college degrees will be needed more and more because of globalization and advances in technology. The Fed chair offered a fairly upbeat assessment about the U.S. job market overall. She said the U.S. has the strongest jobs market in nearly a decade, that job creation is solid, wage growth is picking up, the layoff rate is steady, and there are more job openings. But she cautioned the economy still faces challenges, including low economic growth and weak productivity gains. While Yellen made no comments on monetary policy, a Fed chair who sees a healthier job market tends to be more inclined, not less, to hike interest rates. But you don't really need a college degree to figure that out. You just need one for everything else. For Nightly Business Report, I'm Steve Leisman.
Coming up, point, click, shop. What the nation's biggest shippers are doing during their busiest days to make sure you get your holiday packages on time. Blackberry is switching gears. The company, of course, known for its mobile phones with a keyboard, is opening a research center for self-driving cars located in Ottawa, Ontario. Blackberry will invest about $75 million. The company, which has been building software to run in-car entertainment systems, will now also build software to run self-driving features.
It's crunch time for the shippers, and companies like FedEx and UPS are pulling out all of the stops, like mobilizing field staff and adding Sunday deliveries. It's all to keep up with a record-breaking number of items ordered online. And as Morgan Brennan reports, the pressure is on to get packages where they need to go.
The countdown is on as UPS, FedEx, and the U.S. Postal Service scramble to deliver an avalanche of packages over the coming days. Today will likely be the busiest day for UPS and one of the busiest at FedEx, with both companies handling double their average daily package volumes. It will also be the busiest mailing day for the U.S. Postal Service, which expects Thursday to be its peak delivery day.
I'm a traditionalist, and also, I like the post office. Stuff gets there in a day or two.
I shipped about 2 packages out, little FedEx things here and there, but mostly it's Christmas cards at this point because so much goes on Amazon.
I think we relied pretty heavily on Amazon Prime as like a company to get everything here in time.
Combined, the Postal Service, UPS, and FedEx plan to ship an estimated 1.8 billion packages this holiday season. To handle it, they began prepping back in January, adding new facilities, new tracking technology, mobile sorting stations, new planes and trucks, and extended operating hours, including some Sunday deliveries and, in the case of the Postal Service, even service on Christmas Day. Shipping software developer ShipMatrix says so far, UPS and FedEx are posting solid on-time delivery performances, with last week's express service rates on par with the same period in 2015.
As long as we don't have severe bad weather or snowstorms, they should be able to hold on to the service levels they have. And the other is consumers waiting till the day before, till the 22nd or 23rd for the last minute deluge of orders, and that is very difficult to overcome.
That is, all three parcel carriers anticipate a double-digit growth in holiday volumes versus last year. So far, both UPS and the Postal Service say they are on track to hit their growth targets, which include forecasts for 700 million and 750 million packages, respectively, this holiday season. FedEx has been less forthcoming, though analysts do expect an update when quarterly earnings are released tomorrow. But with just days to go until Christmas and Hanukkah, a lot could still go wrong, especially if, once again, consumers turn to the internet for last-minute shopping. For Nightly Business Report, I'm Morgan Brennan in New York City.
Oh, look at that. I have a package waiting for me at home when I get home.
Excellent.
That's nice. Okay.
I'm going to go home and
Sometime.
wrap. I'm behind.
Hurry up.
That does it. Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.
Nightly Business Report has been funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do